Good morning. Grab your coffee and let's get into it, because we're looking at a map of the world that isn't showing up on your standard news feed. Right now, the global economy is grinding through what we're calling stagflation light. Growth is sitting at a flat 1.6%, a number that feels more like a standstill than progress. Prices? They're still climbing, with core inflation stubbornly parked at 3.5%. It's a low-energy, high-cost world where traditional plays are hitting a demographic wall. In Japan, Italy, and increasingly the US, the workforce is graying faster than we can automate it. We are seeing a structural exhaustion of the 20th century growth model, but while the rest of the market is yawning and retreating into defensive postures, there's an anomaly, a massive high-voltage spark in the dark that is defying the gravity of the broader market. I'm talking about the longevity biotech market. It's currently valued at $23.2 billion, and it's up nearly 35% in just 3 years. Think about that gap for a second. While global GDP is crawling at a pace that barely keeps up with population replacement, the business of not dying is sprinting at triple that speed. This isn't just a niche sector for the hyper-wealthy anymore, it's a fundamental structural pivot. We're seeing a massive migration of capital away from the safety of 60-40 portfolios and into what I call biological assets. In a world where you can't find yield in bonds and the stock market is choked by high interest rates, investors start looking for the only commodity with infinite demand and zero substitutes, more time. It is the ultimate economic hedge. If you're watching your portfolio right now and feeling the squeeze, this 1.6% growth rate is the sound of a world hitting a wall. But this sector, it's currently tunneling right through that wall, fueled by the realization that if we can't make the economy grow faster, we have to make the consumers of that economy last longer. It's a shift from producing more stuff to producing more us. So, how's this actually happening? What changed? For decades, biotech followed a depressing trajectory called Irum's Law. That's Moore's law spelled backwards, and it basically observed that drug discovery was getting exponentially slower and more expensive every single year. Despite all our computers, it cost more to develop a drug in 2010 than it did in 1950. It was a productivity disaster, a graveyard for capital, but we finally hit the flip. AI-driven discovery is decoupling biotech from those crushing traditional R&D costs. We're talking about 50x efficiency gains in the early stage pipeline. It's like moving from hand copying manuscripts to the Gutenberg printing press overnight. We aren't just guessing anymore. We're simulating life at the atomic level. Look at the hard data coming out of the labs. We've already got 31 molecules in the AI pharma pipeline at the clinical stage right now. That's a staggering 150% jump in just 3 years. VC funding into AI healthcare just hit $6.7 billion, even as other tech sectors saw their funding dry up. And then there's the holy grail, epigenetic reprogramming. This is the technology that tries to reset your cells to a younger state by cleaning the chemical tags off your DNA. That sector alone is already valued at $12.5 billion. One company, New Limit, backed by some of the biggest names in tech, just hit a $1.6 billion valuation after some wild preclinical success in reversing cellular aging markers. It sounds like science fiction, reversing the clock, but the math says otherwise. AI is stripping the luck and the brute force out of biology and replacing it with high-fidelity engineering. We're moving from maybe this drug works to we designed this molecule to interact with this specific receptor with 99% certainty. This isn't just about Silicon Valley garages and quirky labs anymore. The real power shift is happening because we've turned biology into a searchable, programmable database. The engineering of life is becoming as predictable as the engineering of a bridge.
Now, this is the part I find absolutely wild from a geopolitical perspective. When you think of longevity, your brain might jump to tech billionaires in Palo Alto drinking green juice, but the real longevity gold standard is being set by oil money. Specifically, Saudi Arabia's Hevolution Foundation. They've committed $1 billion a year to this cause, every single year. They aren't just funding small-scale academic research, they're buying the very infrastructure of the future.
They've already dropped $100 million into the Prize Healthspan and the Buck Institute. They are pivoting from an oil-based economy to what I call biological arbitrage. They know the oil age has a sunset, but the human age does not. They are trading liquid energy for biological longevity, and they aren't alone in this race. Singapore, facing one of the fastest aging populations on Earth, and the UK are racing to redefine aging as a treatable disease rather than an inevitable decline. In fact, 3 major countries have already made regulatory moves to create longevity zones where these therapies can be fast-tracked. Even the FDA, usually the slowest mover in the room, just granted an animal drug designation to a company called Loyal for lifespan extension in dogs. That is a massive foot in the regulatory door. If you can prove you can extend the life of a golden retriever safely, the path to humans is no longer a matter of if. But when sovereign wealth funds are dumping hundreds of millions into bioessence because they see the writing on the wall, they are front-running what is projected to be a $27 trillion longevity infrastructure by 2030. When the world's largest oil exporters start betting on the resilience of your DNA, the question isn't whether the science is real, but who is going to own the intellectual property of the clock itself? We are seeing the birth of a new kind of petro-bio-power dynamic where the most valuable reserve isn't in the ground, but in the genome. Okay, let's look at this through the lens of history, because the real problem is the gap between the clinical reality and the market hype. This gap is where fortunes are made and where they are absolutely incinerated. We've seen this movie before. In the 1970s, during the Great Inflation, capital fled the broad market because it was being eaten alive by rising costs. It hid in hard medical technologies. That was the era of the first CT and MRI machines, and niche companies like Genentech outperformed the S&P 500 by a country mile. The statistical similarity between the 1970s and today is about 82%, but there's a significant catch this time around. This is what I call the longevity war. On one side, you've got the bulls like Dr. David Sinclair at Harvard and Sam Altman. They're saying aging will be managed like a chronic, treatable condition within a decade. Altman's Retro Biosciences is literally aiming for a 10-year life extension in the next cycle, and they have the capital to burn to prove it. But then you've got the bears, like Dr. Charles Brenner. He warns that the hype is dangerously outpacing the science. He argues that there are still no universally accepted biomarkers for aging. How do you measure if a drug worked if the result takes 20 years to see? He warns that reprogramming cells is a high-stakes gamble that could inadvertently trigger cancer. Morgan Stanley analysts are even calling certain parts of this sector a valuation trap for firms that don't have immediate revenue-generating disease targets. The data is incredible. And the potential is world-changing, but the math stops working if you don't have a clear endpoint or a regulatory pathway. It's not just a scientific debate, it's a boardroom battle for the very definition of what it means to be alive and productive. As an investor, the risk isn't that the tech won't work. It's that it won't work fast enough to satisfy the discount rate of the capital funding it. So, where does that leave us? Let's zoom out to the macro picture one last time. Healthcare spending is hitting nearly 20% of US GDP, and in Europe, it's threatening to swallow entire national budgets. It's a sick care system designed to treat you only after you've already broken down, and quite frankly, it's financially unsustainable. It will bankrupt every major economy by 2040 if nothing changes. The structural shift we're seeing is the move from reactive treatment to longevity-based prevention. It's a pivot from fixing the car after the crash to ensuring the engine never wears out. Life insurance companies and pension funds, the largest pools of capital on the planet, are already starting to hedge their liabilities against these new technologies. They have to. Think about it, if people suddenly start living 10 or 15 years longer, the entire global pension system, which is built on people dying at a certain age, fundamentally breaks, unless, of course, those pension funds own the technologies that keep those people healthy and working. Here's the deal. In a world where growth is scarce and inflation is sticky, your health span is the only compound interest that still matters. We are moving toward a future where biological optimization isn't a luxury for the elite, it's a survival skill for the middle class. The 2026 survival kit isn't just about your bank account or your gold bars. It's about your epigenetic clock and your cellular resilience. In an era of stagnant growth, the only infinite market left is the one that buys us more time. Think about that next time you see a headline about a miracle pill. It might not be a miracle. It might just be the most rational, cold-blooded investment on the planet today. Because at the end of the day, you can't spend your wealth if you run out of time to use it. The biological hedge is the only one that truly pays out in the currency that matters.